Hey guys, welcome. This is Jay, smarthelping.com. I've got a full end-to-end space startup financial model. Goes for up to 10 years. This is probably one of the biggest time sinks I've spent on a model in quite some time. I think I've got 30 hours on this thing in the last few weeks, so it's extensive. It's got a lot of moving parts. Now, some people don't ever get to see the whole model because they don't watch the whole video. So before I start, well, I'm just going to start with going through a quick look at the entire model from start to finish. So in this model, we've got launch revenue, satellite manufacturing, constellation services, which is like direct to consumer, monthly recurring revenue, fixed costs, equipment purchases, other initial costs, cap table, building, CapEx schedule, a loan, which is regular amortization, a line of credit loan, ending value summary, monthly detail, getting all the way down to EBITDA and cash flow, annual detail, executive summary, visuals, discounted cash flow analysis, income statement, balance sheet, cash flow statement, and that's the whole model. Now, that only took me about 40 seconds to go through, but like I said, for 30 hours at least to get this thing all functioning correctly. So now I'll go through each of the yellow tabs and explain how everything works. And remember, you can get the template with the link in the description box below. There will be a one-time fee for the download. Okay, so let's start with company name. This just goes to the financial statements, no big deal. Launch year, this will define the timing. Never change the launch date. This is just automated for display figures. Exit month, this you can select any end month. It doesn't have to be the full 10 years. It could be 5 years or whatever. Doesn't matter. And you can see all our values always checked to 0 with the financial statements. I'll put this back to 10 years. You could choose to include the terminal value or not. If yes, it's going to be a percentage of the 12-month trailing sales. Then we have option to use traditional debt funding for initial costs. Here we're not using any. Total equity required for this project 171 million, which is a minimum cash position based on all the assumptions. Then we have investor and equity or owner equity. This will all come from the cap table, and then you can plug in some income tax rates here for if you're running profitable operations, that'll apply. Then we have our final checks. This is just making sure all the financial statements balance with each other. These should always be zeros. Now we go to the launch. So space company, all the end-to-end space companies I've seen, which there's not a ton of them, but they usually have launch services. So it's the lower margin part of the business, but the assumptions here, you have up to 3 launch types. You could define how many happen per month over the 10-year period. You can also define when you're collecting cash from customers for these launches relative to the actual launch. So this table here defines when essentially the mission starts. This table here defines when the launch happens relative to the start month of the mission. So if we had one launch planned here for type 1, and we have month launch happen after start is 2, that means that we're going to actually launch in month 2 for this cohort. We're going to collect cash from the customer 10% in month 1, 25% month 3, 40% month 6, 25% month 8. Now, these numbers are arbitrary. A more likely scenario would be, let's say this would happen 8 months. The launch would happen 8 months after the mission starts, and I'm collecting cash based on that. So I collect all the cash by the time that it launches, and the amount of cash I collect is based on the actual launch price, which you can define here, and it can adjust over time and by launch type. You can also define when you're paying for your launch costs in the same manner. So here you have your 3 types. What's your total cost for, and this would be direct costs like fuel, propellant, ground support, any regulatory stuff, insurance, anything directly related to the launch cost or launch here. Then you could define what months you're paying for those costs relative to the start month. So if you did one launch in month 1 here, but you're actually or mission start here and you're launching in month 8, this says in month 2 you're going to pay for half the launch cost for that. In month 7 you're going to pay for the other half. So it'd be $750,000 in month 2 relative to this start month here, and $750,000 in month 7. These are adjustable for each type as well. And the reason why I had to make different types is because it's very likely if you're going to have different launch types, they're going to have different times it takes to launch from when you start that one mission, as well as, and if that's going to be different, then you're going to have different payment terms for when you collect money from customers, as well as potentially different payment schedules for when you're paying for the cost of that launch during the time from the mission start to the actual launch month. So all dynamic. This is going to have impacts on accounts receivable, potentially unearned revenue, which is liability account, and really big impacts on cash flow planning. So that's why I added all of this logic. If we go to the right, these are just references for essentially sales and costs over time. And I use this in against the actual launch month to figure out when the revenue and expenses are recognized for these things. Okay, so that's launch. Next is manufacturing. So here, another part of the space industry is manufacturing satellites or different things. So you can do up to 3 types of manufacturing of units that you're going to manufacture, the count of orders you're going to get in each month. And then this is similar to launch where relative to when this order happens, you might be collecting money from the customer over a period of time, depending on how your payment terms work, as well as the different lengths of time it takes to ship the product from when you start with the order. So those are all, again, nuanced because it can affect your cash flow, and it is super relevant. You need to know if you get a big order here, when are you going to collect the cash for that order, and when are you actually going to ship it. Um, the other part of this, so there's going to be a revenue here for these. There's also going to be a unit cost. On the unit cost tab, these are for your 3 types of satellites, and those costs are for direct materials or other direct costs that it takes to get a unit manufactured outside of equipment, because we have equipment and building separate. So equipment tab here, building tab here, these would also go into your count. The depreciation on these would count for your manufacturing costs as well. So don't count those in your unit costs, or if you do count those in your unit costs, for whatever reason, don't double count it on the equipment. So unit costs, the terms on when you pay your vendors for these units relative to when the actual purchase happens. And then the other part of the satellites is you're gonna settle them. You're gonna make a margin on satellites. You're also potentially going to operate and manage these satellites once they're into space. And this is ongoing recurring revenue. So we've got the length of time that a given satellite type is going to be operational in months, the percentage of the satellites that you're launching up there or manufacturing that you're actually going to manage, because there could be some satellites that you're not actually in charge of. You're just launching them up there, or you're just building them for somebody and they're doing their own thing with them. So you can put the percentage that you're actually going to manage here, and then once they are launched, there's always a 1-month offset, and then you're going to have these revenue and these expense items happen every month for the duration of the satellite life, which is defined here. So this is recurring revenue over a set period, and then it goes to 0 after that period. And that's satellite manufacturing and management. Finally, you have constellation. This is so far the highest margin area of space, and this would be similar to, everyone's heard of, or a lot of people have heard of Starlink, or some direct to consumer mobile phone access or something like that. So it probably, you're going to have up to 3 customer tiers, the count of customers you're adding in each tier over time, and then what's the monthly price by tier, what's your direct customer acquisition cost, your monthly cost to maintain that customer or account, one-time revenue when they sign up, and any one-time cost when they sign up. And then you've got 3 retention schedules here to define once a customer does sign up, what are the chances they're still a customer after 1 month, after, after 2 months, after 3 months, 4 months, etc. So here you can define your own dynamic retention curves, and those will apply to each customer cohort as they are added each month. And then the remaining customers that exist over time will be paying these prices. This will be your cost over time. And we'll get into more of that on the monthly detail when you can see how the data aggregates on the pro forma. Fixed costs, pretty simple here. The first part's more for manufacturing. You could define your cost item, the month that cost happened, and the annualized cost here, and you can adjust it by year. Down here, these are just fixed overheads, so you could define, again, the type, the start month, and the annualized cost. And then if it's a salary item, you can mark it a 1 here. If you do mark a 1 in column N, it's going to take a payroll tax and benefit percentage and increase the cost by that much. I also added down here extra costs for fixed, and there's like 100 or so, 168 more slots because you might need to account for more things and expand. So I added more slots for that here. And then besides payroll tax and benefits, you've also got the percentage of units you manufacture that end up being wasted or not sold, as well as a failed launch rate, which just reduces the launch revenue. And then you've got months ahead that you're purchasing these raw materials. So this, putting a 3 here, just means that these unit costs for direct satellite manufacturing, it just means you're purchasing all of these costs every 3 months. So for month 1, 2, and 3, you'll buy in month 1. For month 4, 5, and 6 of these costs, you'll buy in month 4, and that's dynamic for each type. Okay, we go to equipment. I kind of touched on this. You just put the month that you're going to purchase the item, how much was the cost, how many did you purchase, total cost, useful life or depreciation, and then your allocation to each of the types of satellites you're manufacturing for each of these. This row should always add up to 100%, but it doesn't have to include all 3. You might purchase a piece of equipment that's just used for type 1. In that case, you'd put 100%, 0%, 0%. Also the start month of each type, and that's just going to really define your checks here to tell if essentially this is starting within the time that the actual equipment has started in service here. Okay, other costs, these are just initial one-time costs that hit right up front. Cap table here, the model's going to spit out this number up top, 170 million in this case. That's the minimum cash you need to get operations going and keep your cash balance above 0. So with that, you can define, usually people just use these first 2 columns. You can define how much of that money is coming from outside equity investors versus inside. And if you put 0 and everything, it'll just default to the overflow. But in this case, I've put 25,000 here for founders, and they're raising the rest. The 80% for founders, 20% for the rest, and these are all adjustable. Let's say I wanted to put $1 million here, it would just or 10 million there. You can see it adjusted the overflow by 10 million down, and then the totals from this plus this column should always add up to exactly this amount. That's why I put the filler in here for any remaining that you haven't populated elsewhere. And then this column here plus this percentage here should always equal 100%. So here we've got 20 and 80, remainder 0, so that's a good check. And then you've got your cash flows IRR for each individual based on the percentages. All right, building, this is just a simple one-time cost. This one is always going to hit in whatever month you define here on the CapEx. So you could define that here. That's when this cost happens, useful life, and then you could also define manually the expected sales proceeds at exit. Oop, my Excel's being funny. So that's building or plant, CapEx. This is all automated except for this one selection for the building purchase month. Then we have our loan. So we define the amount of the loan on the control tab, but we have the term, the interest rate, payments per year, and first payment date, all dynamic on this tab. And then you've also got a potential to use other monies, line of credit specifically, where you just define the interest rate and the amount you're drawing here and the amount you're repaying. You can adjust this interest rate manually if you want in column E, and that will adjust the interest calculated here. And then I also put in some helper columns to show you what your cash balance is. So you can see here it's at the end of April, it's negative 109. Let's say we need to put in, let's say 20 million. You see now that goes to 89. So you can see how that will impact cash balance. And this is cash balance before equity. So this is not saying that you're operating at a negative. It's just saying the minimum here, in this case now it's negative 170. Whereas before, well, this isn't going to change much because you've already hit your max negative already. You'd have to put this loan amount up here and there. Now you can see it affects the actual minimum equity requirement. But this is a nice helper to plan out when you're going to need money, depending on how your strategy is for all the other assumptions we entered. You'd also manually repay it here. Now auto repay will happen. You can see here the balance is being repaid no matter what, whenever the forecast period ends, assuming you're going to have an exit. If you hit no here, and then it's not, and it'll just run through the end. No repayment, and it'll just be a balance at the end of the forecast period. Okay, ending value. This is just to allow you to account for taxes a little bit differently on the exit if you want to apply some of the exit value to your fixed assets versus extraordinary income. This is not a big deal. Usually, a lot of people just put 100%, and it really just has impact on the tax calculation on the exit month. But it is there for if you want to play with that number. Now, those are all the assumptions. So we have our monthly detail, and we've got some summaries here. So up at the top is the satellite manufacturing, the satellites ordered, when they're shipped, the recognized revenue of satellite sales from manufacturing, your cost of goods sold, which is those raw materials on the unit cost tab, when those costs get recognized. And that's the difference between the costs ordered and the recognized is the amount of time it takes from the month the order happens to when it ships. In this case, you can see this 350 happens here, but it doesn't ship till month 5, and that's because this 5 right here. Now, if I were to put 4 here and go back to the monthly detail, now you can see that 350 is happening 4 months. It's being recognized as revenue 4 months after the actual order date instead of 5. So these are all dynamic. We have depreciation of equipment and building. These are just taking the total depreciation cost divided by 3 and applying it to each of the types of things being manufactured. And this is the amount per unit. From the property and plant. Now, these numbers, the equipment numbers, will flow. These depreciation costs will flow to EBIT, which is an important number, especially with high CapEx. businesses like this, so that will not affect cash flow, but it does affect the EBIT calculation. We have our indirect overhead costs, total cost of goods manufactured. These are all your satellites, gross profit of manufacturing. And you can see we do get profitable as we scale up. Then we have satellite operation and management. So these are your ongoing revenues from those activities. And notice the first month 4 was the first month we shipped, and then 1 month after that's when that revenue starts. And this scales just depending on how many satellites you're manufacturing and what percentage you're going to manage over time, and also the length of operation of each satellite type. So satellite operation management, launch services of each type. So here's your launch revenues, here's your launch costs being recognized, launch gross profit. Then we have our constellation. So here's your recurring customers. You've got tier 1, 2, and 3, which we start all the way over here in month 36. So here's the customer starting. We've got some churn based on our retention curves. You've got the monthly recurring revenue of the customers that exist for each type. You've got your total constellation customers, your MRR for that. Then you've also got one-time revenue, initial cost of acquisition, any other one-time costs, and ongoing cost to manage these accounts. Total constellation revenue, total direct cost for constellation, gross profit constellation, and that's all the different revenue streams and their direct costs. So we can now calculate gross profit by month. Go back over here. Then we have our fixed operating costs going down here. We have a payroll tax and benefits cost. This kind of follows the same layout as the fixed cost section in order from top to bottom. You got your waste, launch revenue fails, costs, and then total fixed expenses, and then you've got EBITDA, EBIT, any debt service from any loans, which here we have none from the traditional amortization loan, but we do have the line of credit funding, which is down here. So that funding is that, the repayment here, and then the interest cost from that loan. You see it's being fully repaid at the end. And then also to get down to cash flow, we have some other items. We've got exit value, taxes, CapEx, raw material purchases. So this is following that schedule of every 3 months. Now, if I were to put, where was that? Let's say I put this to 4 months, so you can see now these costs are happening so you've got month 1, 2, 3. Well, actually, we've got purchases offsetting here, so it's kind of hard to see because there's multiple things happening. Let me see if I extend that out to 5. So you can kind of see the differences. It's still hard because we've got, if you go over to our inventory calculations, they're all the way over here. So these are happening in sequence, but it's based on when, it's also based on when our manufacturing orders are occurring. So this difference here is going to give you some different, it's not even until we get further out in time. Then it's more, and then yeah, it's more even after that. Yeah, but these first few, so I made 2, yeah, so this, there's a gap in the second type, or sorry, the first type. So you're not going to see super even, but let's go all the way out a little bit further in time. Yeah, actually they're always going to be offset then after that. I'm just trying to demonstrate the point of this really quick. So let's go, let's say these are just an even amount of orders every month. And then it's shipping, that's not relevant. And this is when it's being paid. Okay. Yeah, there you can see it's pretty even now. So here, now the difference, okay, so here's why I was confused. These are when the purchases happen, but the payments, this is when payment is happening because we're trying to get down to cash flow. So if we go up here to our purchases, well, no, actually, so I would have to, if you want to see the actual difference, you'd have to put this at 100% up front. Now, if we go to the monthly detail, you can see that, there you go. So there's, assuming you had to pay all the costs up front, you're paying those every 5 months or whatever you put into here. If you put this back to 3, you're paying every 3 months. But this model allows you to say, well, I don't have to pay for all these purchases up front. Maybe you pay 50% month 1, maybe 50% month 3. So then we go to our cash flow. Okay, now there's an offset here. When you actually have to pay for these, could be different than when you're actually making the orders. So it's very dynamic. Gets you a nice cash flow number. Also down here we've got logic for receivables on the launch and satellite manufacturing for cash flow. These are all important for the balance sheet. And that's pretty much it going down through the whole monthly detail. Annual detail is the same thing, but just on an annual basis. All the way on down. Executive summary here, you can see total active satellites being managed over time. Total launches happening per year. And then you've got launch revenue, satellite sales, which is your manufacturing, satellite management, constellation MRR, and constellation one-time revenue. Total revenue. Then you got depreciation, materials costs, depreciation from facility plant, and direct overhead. Then here you've got launch costs, satellite management costs, and constellation direct costs. So we can calculate our gross profit and margins of each line of business, which we do calculate down here and put that in the chart. You've got total direct costs, gross profit, all your overheads, total expenses, EBITDA, EBIT, debt service coverage, your term loan, and then all these other items affecting cash flow, and then your cash flow per period. Also, you've got internal rate of return for the project and for the investors and owners separately as well. That should equal, if you add up these, the total up here, which it does. Yep. Okay. And then visuals, I did active satellites by type, stack column. So the total of the column here is the total of all 3 bars combined, but you can see how much of each satellite type you're manufacturing over time. Total active satellites, and these are satellites that you're actually actively managing. Yearly launches, total yearly launches, annual revenue by type. So here you can see where you're getting your revenue from each year. And then also the percentage. So this is the same data as this chart, but you're just seeing the percentage of the total represented in the bar. And you can see in this case, satellite management services is our biggest revenue stream over time and our biggest, we're earning the most from that over time. Again, these assumptions though are arbitrary. You put in your own figures to produce output that matches your scenario. You've got your gross margin, gross profit margin by type as well here for each of the revenue streams. Then total gross profit percentage, inventory, accounts payable, cash flow, annual EBIT, and some other accounts here from the balance sheet. Discounted cash flow analysis of the whole project. So you can put in a discount rate for the project and figure out what the return is on your initial investment over the 10-year period. And you can also do that for the investor and owner side of it. Income statement. all your, this is kind of like the executive summary, but a little bit more detailed. All your revenues, direct costs, other expenses, depreciation, interest. You get tax calculation down here. And then balance sheet. Now this thing was tough because you've got different inventories, you've got accounts receivable, your fixed assets, you've got accounts payable from manufacturing as well as for launch, unearned revenue potentially for if you're collecting cash before the launch happens, or collecting money before you ship the satellites that you're manufacturing. Accrued taxes, this is just showing taxes being paid every 3 months. And then retained earnings down here, and everything all balances out no matter what you put into the assumptions. As long as you're not changing any logic, it'll always balance. And then cash flow statement showing, again, this was not easy to code in accurately. It took a lot of time, but it is worth it in my opinion. I think this template could be used for a lot of references for different financial models that have these types of accounts in them, but it's super useful here. And then if we go all the, sorry about that. If you go all the way to the right, these are dynamic tabs that calculate all of the different things so we can get these numbers correct. You've got launch in L1, M1 is your manufacturing, C1 to 3 is your constellation, MA is your direct material purchases, and the depreciation matrix over here, and validation is just dates for all the drop downs, which automatically adjusts as you change the launch year. A couple things to note about this. On the control tab, if you do change the launch year here, it is important to also change your starting months in the different tabs. Definitely the equipment tab. If you don't change these months, but change your launch year to some point in the future, you will see an error over here and these will not match. So just a matter of making sure these dates match your launch year when you change it. For example, if I were to put this to 2025, you can see there's already going to be errors here because these dates need to be upped. So the drop-down automatically updates when you change that launch year. So I would want to update these accordingly. Also on the loan tab, you want to update that number. I think that's mainly the two, yeah, equipment and loan tab. If you change the launch year, you want to change those months. Fixed costs as well. Now that won't cause you an error, but it's not, you're going to want accurate data, so you're going to want to change those. Constellation, there's no dates here. This is all just based on month numbers, so there's nothing here you got to worry about with the dates. All right, well, that's pretty much it. Like and subscribe. Again, you can buy the template in the link below. One-time fee, and if you go over, I will post this. Let me get over here to smarthelping.com. This will be under the industry-specific models, and in the industrial sector right up here at the top. It'll be the first one. So it'll be included in this bundle. That total bundle for the whole industry-specific models. I'll also put it in the Super Smart bundle, which is going to include everything on the entire site. I've got hundreds of financial models, so check it out. I've built these things for the past decade. I'm going to keep building them. Let me know in the comments what you think about the model itself. And oh, I do work for hire, $275 an hour, and right now there's a two-day wait. I've been too busy the last couple months, so I had to put a little bit of a wait. Sometimes there's no wait if I'm not super busy, but yeah, I can work through any financial model you want to build, or if you want to customize an existing template that I have, I work on a pay-as-you-go basis. And finally, before I go, remember, the model could have errors in it, and I'm not liable for any financial gain or loss using the model, and you would put it in with your own assumptions and use at your own risk. This is not financial advice. Alrighty, Take it easy, and I'll see you on the next one.